Hello, everyone. Welcome to today's Wild Digital Online series. We are very pleased to have you. Thank you for taking the time. And as always, we promise that this 1 hour will be a very rewarding one. And I've been talking to the two Michaels. So this is the Triple M show. Myself, Martin, Michael Lints, and Michael Blakey. We've been chatting before this, and they've got a lot of interesting insights, secrets, war stories to share. Good afternoon. My name is Martin. I'm partner of Genesis Alternative Ventures. Genesis is Southeast Asia's premier venture debt fund. We're a profit for purpose fund providing debt capital to empower growth and minimize dilution for the region's leading venture backed companies. Why are we here today? Wild Digital. Thank you, Wild Digital, for having us. Wild Digital is Southeast Asia's premier tech conference platform. With COVID, it introduced a series of online sessions specially curated for the Wild Digital community to hear tips on how to tackle challenges caused by the crisis, as well as listen to latest trends that the tech landscape in Southeast Asia is seeing right now. And this is part of their lead up to their flagship Southeast Asia conference. So, without further ado, I'm really excited to be introducing to you my two esteemed panelists. Seeing that we've got two Michaels, I'll go by their last name, Lints and Blakey. So, Lints is partner at Golden Gate Ventures, among other things. They're a growth fund as well, and Blakey, managing partner at Cocoon Capital, a leading seed investment fund. So these two fund managers are leading veterans in their respective fields, whether it's in growth or seed stage investing. So I have great respect for the way they approach investing. And today, let's dive right in and get them to introduce themselves. Maybe B go first. Blakey goes first.
Hi there. Thank you very much for that, Martin, and thank you very much to Wild Digital for putting us and hosting this session. So, as Martin rightly said, I'm Michael Blakey. I'm a co-founder and managing partner at Cocoon Capital. A bit of my background is I'm an ex-entrepreneur, but for the last 20 plus years, I've been an early stage investor. Started off in Europe, and then in 2013 came over to Southeast Asia. I predominantly have always invested in kind of pre-revenue and early stage revenue companies in either enterprise or deep tech. So I've invested in things as far afield as robots and wind turbines, fuel cells, all the way to kind of logistics and telco and e-commerce marketplaces, and even functional water and cosmetics, some of my earlier ones. I set up Cocoon Capital with a guy called Will Klipkin, another entrepreneur and a long-term early stage investor back in 2016. We follow on very much what our belief is to invest across Southeast Asia, be the first professional money into companies. We are what we would term active investors, so we do very few deals a year, a maximum of 6, and then we work very closely with the founders, helping them on BD strategy, as well as the normal fundraising and everything else that you would expect from a VC. And when we've invested in Myanmar, Vietnam, pretty much in every major country across the region now, and we invest anywhere probably between 200 to $500,000 or $1 million, and then we also follow on. And that very briefly is myself, because I know it's more important to talk about the questions and how we spend 10 million rather than about ourselves. Right. So after you, over to you, Lints.
No, but one thing.
All right.
So what's that one thing you learned about yourself while under lockdown?
Oh, I would probably say that I work better around people than by myself in the bedroom. I haven't seen a human being face to face and had a proper conversation. It was like for about 3 months, and I definitely lost the energy on that one. But no, I enjoy meeting founders face to face and getting to know them on a personal level. I'm not one of these people that after lockdown is going to be happy staying in my room talking to people over Zoom. I probably will avoid Zoom for a period of time, I think.
Okay, I'll get you out for a cup of coffee or beer in person.
I'll hold you to that. I'll hold you to
okay.
that. Okay.
And Lints, over to you.
Sure. So Michael Lints, partner at Golden Gate Ventures, as you mentioned earlier. So in my personal background, I'm a software engineer, computer scientist by training, born and raised in the Netherlands. Moved to Singapore about 7 years ago. So I moved for the job. Prior to Golden Gate Ventures, I've worked for the ING Group, which is a large bank and insurance company in the Netherlands. I learned that I couldn't work for a corporation, so decided to sell my house and car and start my own business with two good friends, which was a data center. That company eventually got acquired, which left me with time to do something else. So I joined as a vice chairman in the Economic Development Board, which was a board set up by the Dutch government to encourage public-private relationships and public-private partnerships. So I've been doing that for 4 years. Also learned that politics was not my go-to. So, wanted to go back into technology, started with some of my own investments, and eventually made the jump to join Golden Gate Ventures back in 2013. And that has been an amazing journey ever since. So Golden Gate Ventures, we do early stage and growth. With early stage, we mean Series A. So effectively, that means anywhere an investment from 1 to 5 million. But we also look at growth companies, which is companies that are at the Series B stage. And then we have a smaller crypto fund called Lunex, where we kind of look at new opportunities that are in the blockchain space. We are a team of 19 across 2 countries, headquartered in Singapore, but we have an office in Indonesia, Jakarta as well, as a big portion of our portfolio sits there. We tend to be I say a generalist investor, so we look at everything that revolves in the consumer space, but we also have investments that are in the B2B space. Companies that people might know in our portfolio would be Carousel, but also recently Ninja Van. So we have a long history of investing in companies that are in the consumer space.
Thank you, Linz. So what's that one thing you learned about yourself while under lockdown? I know you run a lot, so don't tell us about the running.
What I've learned during lockdown, that's an entirely different session. I would say that so as a VC in Singapore, travel is a big portion of your work. And one thing I've learned is that I will definitely change my travel schedule once we get out of COVID. And similar to Blakey, would be great to see other human beings again as well, for a beer or a coffee or whatever.
Definitely.
Join
definitely. Right. So, I put out a poll just before the session. So just wanted to get to know our audience as well. How many investors, how many entrepreneurs we have. So we've got an overwhelming 53% of our audience who are entrepreneurs, 28% are investors, 19% are still undecided. And second question, if you're an investor, 61% are taking a wait and see approach. So hopefully after today's session, they say, it's not, invest and wait. Don't wait to invest. And third question, if you're an entrepreneur, 33% are actively in the market to raise money. Another 25% are planning to raise money in the next 6 months. And the 42%, very fortunate, do not need to raise money. So hopefully for the audience with certain questions, we hope that you'll be, just feel free to fire away with the Q&A, and we'll try our best to answer all the questions and make it as interactive a session as possible. So diving into the panelist question session. Lints, you talked a little bit about politics and all that. Like, can you share with us how you got started on your professional investment journey?
Um, well, it started early on, and I kind of stumbled into it. It's funny how after you have exited your business, the natural question then becomes, oh yeah, am I going to be an investor? I didn't consciously say yes or no, but it just happened. So it effectively meant that as a former entrepreneur, you had companies coming over like, "Hey, I'm building this. Do you want to have a look?" Or, could you help me put some money to this? So it sort of naturally evolves, because I think what founders tend to do, and this is what I did myself, is you look for people that have kind of gone through that journey and see if they can be helpful. And that help is not just money, but it's also with advice and being a sounding board. So for me, it was literally about stumbling sort of in that business the moment I exited my own company.
Yeah, that's that's a very, very interesting response. And I've been in banking for a while now. If you ask me when I started my career, if I would be running a fund and talking to you guys online, I'd say you guys are crazy. I much prefer to be a banker. But you kind of stumble into it, and it just make things just work out like that. Blakey, yourself?
Actually, very similar. I got out of a startup, and I was planning on doing my next startup after I exited. And I had done it with my brother, so I'd exited out of my brother. So we thought we didn't have any good ideas. We thought that we would just invest in a couple of other people, and we wanted to learn more about tech. So I joined a tech startup. And on the side, I was doing investing, and it was purely just to get better understanding so I could do another startup myself. And that was 20 years ago. I never kind of stopped investing. I find angel investing and any investing in early stage companies rather addictive. And I also realized, talking to a lot more founders, that, and pardon my language, I was an absolutely shit founder. If I'm honest about it, is that I had a lot of the traits which meant that I was never going to be able to build a scalable business, which is what I really wanted to do. But what I was very good at is helping other people solve problems and avoid all the mistakes that I made along the way. And definitely a lot around like the personal, building teams and personal development. Like I wasn't very good at delegating and prioritization, which as a founder you have to be very good at, because otherwise when you scale you just work longer hours, which is not healthy. So so it wasn't a planned. I mean, I've never taken a business class in my entire life, or any of these things. I've learned very much in the school of hard knocks. But it's something that I'm extremely passionate about. And I've focused always very much on the early stage.
Right. And I guess the founders that you speak to will be able to resonate, because you've been on the other side before. If you were not a fund manager, what would you be doing then?
The one thing I learned, and I think this is very much the same as Lints, I tried corporate life and I was shit. I couldn't deal with the politics and I got bored very easily. I think it's one of the reasons I ended up being an entrepreneur, is because I've never fit into a structure. Well, I'm severely dyslexic, so I always had to figure out ways of actually getting even through the education system. And I learned failure from. So if I was an investor, I would go back to starting up a business again,
Right.
and trying to figure out something to do. And I would try and work with people around me that could actually cover all of my weaknesses. It's kind of what I do now, to be quite honest, if I look at the team that I work with. But yeah, it's definitely would not be going into corporate life at all. It will be startup world all the way.
Okay. So for the benefit of our entrepreneurs as well as investors, these days when we talk about VCs or investing, everyone thinks that, yeah, it's just guys running a fund with a lot of money, right? But, for entrepreneurs to be a bit to increase the success rate. Like it's really about, like, if you're raising a seed fund, go talk to a seed fund. If you're raising a growth series, go talk to a growth fund. So Lints, can you share with us your firm's general investing philosophy and strategy, so that the right crowd goes to you later and the right crowd goes to Blakey later?
Yeah, so you know, we said beforehand this would be like more of a bar conversation. So
Yeah.
I do want to,
Yeah.
I don't want to give any polished answers, but I just
No,
want to give.
no, I'm not expecting a polished answer, but just in
Good,
general, you know.
yeah. So it's very difficult to be very generic and general about, you know, what are we looking for, what is our investment philosophy. I do think there's a few traits that if you would ask anyone within Golden Gate Ventures, they would say the same thing. So the first one is, because a lot of our team members, a lot of the other partners have gone through a entrepreneurship journey. You can ask Jeff, you can ask Vinny, you can ask Paul, you can ask Angela. They've all kind of been through that entrepreneurship journey. So whenever a founder, you know, comes to us and say, "Oh man, we messed up," you know, or "This is really difficult," we sit down and talk, as opposed to immediately jump back and say, "Oh, you know, our investment is in danger, so we should be changing something." So I think being entrepreneur friendly is a difficult word, but at least having a lot of empathy for the founders we invest in, even for the founders that are not in our portfolio. There's a lot of empathy from our side, and that kind of you'll notice that within the entire company, and that is important to us. So as part of our philosophy is, whenever we invest in a company or whenever a company pitches to us, we want to understand that, are we able to work with you as a founder? Are we able to have, I mean, we're not sure if we're going to exit the company in 4 years, 10 years, maybe even longer. So we would have able to work with you over that long of a period. So those in terms of philosophy, having those initial conversations with the founders is extremely important to kind of the rest of our investment journey. So that is a big portion of it. I think the second thing is, and that's something that I really had to learn. You know, on the one hand, we love you know, headstrong founders. So you're looking for, you know, best of class, best of breed, because again, in the end, we need to return the money that we invest. But for the same time, you're looking for founders that are important as part of your philosophy, that are humble and willing to listen and willing to work with people that are better than them. I love a founder that literally says, "I want to hire someone that is better than me in finance, or that's better than me in marketing, or better than me in business development," because that shows real leadership. So I guess a lot of our investment philosophy revolves around the persons, the founders, the leading team. So that's one big part of it. I think the second big part of it is, there has to be, and I know that nowadays you have to be careful saying this, but you know, how do you look at scalability and growth, and not, you know, nonsensical growth and just growing for growing? That's a thing of the past. But really, if you are a business, are we able to understand how big this business can become, and how big is this going to scale? If you're building a business that is going to generate you know, 1 million in revenue over 7 years time, that's just not something a VC can invest in, because it doesn't generate the returns that we need for our business. So yeah, so I'd say that the biggest portion in terms of our philosophy revolves around having a lot of empathy for the founders that we invest in.
Blakey.
I would say, look, it's definitely a people's game. You know, I come in, so where Cocoon sits, I would say we're very much a feeder fund for like the Golden Gate. So we come in normally like pre-product or very early stage revenue, or when a company is looking their first $500,000, $1 million. So they really haven't got any traction. The team is normally the founders. Maybe we're lucky and they have 1 or 2 employees. But our philosophy, and we are very much focused on enterprise and deep tech. So we don't look at direct, you know, pure consumer plays. That's not where our knowledge is and our skill set. you know, and if I was giving advice to entrepreneurs, it's not all money is the same. You know, money comes with different strings attached. When you take on external funding, you actually lose control of your business. You know, even if you've still got, you know, a lot of founders think, oh, as long as I keep 51%, if I have 60% of the business, I control the business, it's still my business. Sorry, the minute you raise external funding, especially from professional investors, there's things like minority protections, and people kind of forget about that. So when you're looking, you know, so whatever I say, it should be very similar to how an entrepreneur looks at it, which is very much what Michael said. This is about a relationship. This is, you're getting into bed with somebody that at my stage is probably a few years, you know, Lints will come in a couple of years after I've come in. So you're looking at like an 8 to 10 year journey, you know, which is longer than I was married for. So it's kind of like, you want to make sure that, that you actually can work with and that you trust the person that you're taking the money from. And we think of it as that we're giving money for. So it's, you know, even though, you know, VCs don't talk about this that much because they'll get into trouble too. I'm an idiot, so I talk about the first thing, the most important thing for a VC when we're looking at a company is, do we like you? Just right. It's, if we don't like you, it's going to be very hard for us to trust you. If we don't trust you, then there's no way we're going to be able to invest in you in terms of, you know, our stage, there is normally no product, there's no revenue, whatever. So our literally 100% of our investment is in the people. And so on that side of it, I think it's really important, you know, and I talk about this a lot, it's every interaction that a founder has with a VC tells us something about you and how much you want to work with us. I mean, I can look at my inbox today and I probably had about 3 or 4 companies reach out to me, and they'll start off with like, dear sir, dear ma'am, hello Cocoon. And I'm like, okay, this is just a spam email. This is not, you're not showing me the love. So why should I show you the love? There's one company that actually went to one of my portfolio founders. The portfolio founder said, look, Michael, I've been talking to this guy for 6 to 12 months. He's exceptional. They've tried it. I really, you know, are you happy for me to introduce? And I was like, hell yeah. I said, just send me the deck. I said, I'm not going to look at it. I just want to meet the person because they've obviously taken the right approach. I trust you because I've already invested in you. For me, and I don't know, Lints, if it's the same for you, but if a company comes through, if one of your founders, you know, introduces you to another founder and say, you should talk to this guy, I'm assuming for you, it's going to be a guaranteed meeting, irrelevant of what they're doing.
Right away, yeah.
You know, so the founders out, and it's not hard to find out who our founders are. You know, we all put, you know, we're VCs, so we want to talk about our wonderful portfolio. Spend that, it shows that you're, you know, if you were, for me, I look at how you raise money from a VC to how professional you are to actually selling your company to a potential customer. I have very few interactions with you. And if I would never expect you to, if you could find a way to be introduced to a customer, just doing a cold email, the chance of success is minimal. Going through somebody who gives you a warm intro is naturally the better way of doing it. So I would say our philosophy is similar to Lints. It's about personal. We're slightly more focused, and we, you know, we are at the earlier stage. But I think we have all of these investment criteria about what we do. I think we've just about broken every single one of them because the person is so good. We're like, oh fuck it, you know, the person's so good. We'll explain it away later on. You know, which does sometimes get us into trouble, admittedly, but it's a people game, and it doesn't matter if you're at the seed stage or if you're at Lints at the growth, or even if you're kind of on the stock market. Everybody looks at the people as part of it, and if they're good, they'll forget what they should be doing and they'll go after the people side of it. So I think it's actually similar across the board. The problem that I've got to be really careful of is, and I see this happens a lot, it's very, what you commonly see are the good storytellers are the ones that actually raise the money. it's not actually necessarily the better businesses.
Totally agree with you.
Because at my stage, there's no data points. You know, Lints, you know, I would say, I'm going to say that you have the easier job. You can shoot me and disagree with me. But at least when Lints looks at a company, he's got some data. There's some customers. There's somebody has actually spent money or bought, you know, the product that, you know, that the company is building. I'm going purely by, okay, you can tell me a story. And one of the things that I've been amazed about is how bad founders are on the whole of actually talking about the problem statement. I focus more on the problem than the solution, because most of my companies haven't got product market fit.
Right, Blakey, let us hold it there first, and let's move on to, let's switch gears a bit.
Yeah.
So we are seeing a lot of deals still being announced, you know, some at really respectable amounts relative to their series. We're seeing a lot of double-digit Series A rounds, and you know, just wanted to check in with you guys. You know, how has the current situation, COVID lockdown, recessions and whatnot, travel restrictions, changed your firm's you know, how deal making pace as well as strategy? Like, you know, we've heard a lot of funds saying that, look, we're supporting current portfolios now, and then yet some other funds are saying, look, we continue to invest. Blakey, you mentioned that you've been busy, still continue to invest. Can you share a little bit about the current situation?
Sure. Who wants to go first?
Sorry,
maybe
Lints.
Oh, maybe Lints go first.
Sure. Yeah, I think, I mean, any VC that are doing their work properly would have to say that they are supporting their companies, because you know, your initial job is, once you've made an investment, to make sure that that investment works. And for, you know, crises like this, it does mean that you would have to talk to the founders and see where you can be supportive, and whether that is facilitating a bridge round, if a company needs to make cuts, is, you know, helping them and you know, making sensible cuts. Yeah, also making sure that this is, you know, a temporary situation, and, you know, once things are lifted again, that the company is kind of ready for growth. So 100% that we have spent and will continue to spend time on the portfolio where that is needed. So that doesn't change. Yes, of course, we are still looking at new deals. You know, the last fund we raised, our third fund is from 2018, so we still have, you know, dry powder in that fund. So we're definitely looking at new deals. I think the deals that you've seen announced across the board have been deals that have been longer in the pipeline. It always takes a bit of time before they are actually announced. So those were probably deals that were in the pipeline. In terms of, you know, being in Singapore, yes, new deals have definitely slowed down. Where, you know, we used to hop on a plane to Jakarta for a meeting, or to, you know, Ho Chi Minh City, or to Malaysia. That is not happening right now. So that slows down meeting new founders, because for the founders that we haven't met before, face to face, physically, and that come inbound, we'll definitely do work. So we'll definitely make sure that we spend time on them. But it also means that, you know, your due diligence is just differently. And for some businesses, we just like to see, for instance, the office, and see how the interaction is with the team, or meet and talk with a few of their clients. That is not possible. So that slows down. And that also means that the pace of doing new deals automatically slows down with it as well.
Right. Blakey.
Look, I would say I definitely agree with Lints. There has been, even though that you still see a steady stream of announcements of new deals being closed. A lot of those were done in, you know, 6 months plus ago. You know, one of the things is deals aren't normally announced within a, you know, 2-3 month period of the money coming in. And I've known in instances where, you know, especially because a lot of the companies want to build the product. So a lot of my companies want to build a product, get everything. So it can be up to 2 years before they actually announce the fundraise. It's a bit of free publicity, which the company uses, but they don't want to use it before they're ready to actually talk to customers. I mean, as you rightly said earlier, I've never been so busy closing new deals in my entire life. In my whole 20-year career, I have not closed so many new deals My lawyers, I think, hate me at the moment because I'm keeping them well too busy. So I am supporting our current, Cocoon is definitely supporting its current portfolio, but it's very small. We don't do that many deals, and we're a relatively new fund. So we only launched in 2016. We've got our second fund, but I think in total now we've still got less than, I think we've got a portfolio of about 20 companies. Right. Lints, I'm probably assuming it's 40, 50 plus for you guys. So we haven't, we've only got a team of 5, but I've also lived, and so has Will Clifton, my co-founder, through a number of downturns. We're old enough to have lived through the dot-com boom and bust. So we've seen a lot of this. We're able to react quite quickly. And what Will and I have noticed in our portfolio is some of our top investments that we've ever made have been done in downturns. So we have been like super aggressive. And the reason I know not many deals are being done is that when we're talking to what I believe are exceptional businesses, quite often the founders are very honest and say, well, we're the only ones even willing to talk to them. Everybody else is just saying, come back to us in a few months, or we're focusing on our current portfolio, or we're not going to do anything until there's some clarity in terms of where the world is going to go. And as a fund, if you don't invest for a 6-month period, it doesn't kill you. You normally have a 5-year investment period. So I totally appreciate why other VCs are there's not, the important thing I think for entrepreneurs, there's not one model how VCs run. There's many, and there's not one right way and one wrong way. There's many different philosophies. You just got to figure out who is investing at this point in time in closing deals. One of the ways of doing that is using something called Venture Insight. It's a really cool tool that we use that actually tells you when deals are actually being closed, not announced, but actually closed. Right. And that you can just look at who's making the investments. In terms of how we're closing them. Sorry, Master. Yeah.
No. So no, there's a question now from the audience, which I think is interesting. So how is the current situation changing your sector focus, if at all? Lints?
No, it's still people.
Still people. Yeah. Lints?
in general, it would be weird to make a big shift in your sector focus, because generally funds are managed and run over a 10-year period. So something that is extremely hot or makes a lot of sense right now, and if you go all in, you might scratch your head in a year's time because you're like, oh yeah, the world has changed again. So we haven't made a major shift in terms of, oh yeah, we're gonna have a different strategy. But in all honesty, we're still a business and we still need to be opportunistic. So yes, we definitely keep our eye open for, are there certain sectors that make more sense right now? And, one eye opener for a lot of people was, home-based learning. I have 2 kids, 8 and 4. We've done homeschooling. There are a lot of tools out there, but there's also a lot of improvement and innovation that can be done on that side. If you look at healthcare, if you look at how are we going to work coming out of COVID, and how long will that change be? So yes, we definitely keep an eye out for new trends, but that's part of our job. That's what we have to do as a business. So in the sense that, has our situation changed in terms of sector focus? No, it hasn't. Are we keeping an eye out for opportunities because of COVID? Yes, we definitely do.
Great. And that's also part of the excitement of being a investment manager. So I just want to talk a little bit about travel restrictions, right? So with travel restrictions, what's the best way that foreign startups, whether they're in Vietnam, Indonesia, can attract your attention?
I think
that one.
Yeah, I think the reality is that we've still got, how you approach a VC, it tells them a lot. And there's ways that you can shortcut, or there's ways that you can personalize it. As I said, one way obviously is talking to our portfolio founders and getting them to do an introduction. And they're not just going to introduce anybody, because they know they're putting their relationship on the line when they don't want to introduce crap or companies they don't believe in, because that could potentially damage their relationship with the investor. So, you know, if they're willing to put forward, that's one way. If you can't reach out doing it that way, do the direct approach, but try and personalize. You know, the most important thing, a lot of people spend a huge amount of time working on their deck and they forget about the cover email. Actually, a lot of VCs probably won't admit this, but the cover email is sometimes as far as they get when they're looking at an opportunity. They don't even get to the deck.
Some even get the name wrong.
You know, oh yeah. I don't worry. My last name for some reason seems to be a really hard one for anybody to spell. I'm normally Blakey.
Blakey.
Or you know, but it's little things like that. Or you know, so Michael, I saw you doing the Wild Digital webinar, and I really like what you said on this. I think this is something, you know, I'm taking that approach. If you can personalize it, it's all about building a relationship, and it's a step-by-step thing. So how you approach it, if you treat it like, you know, like a Tinder, you're just going to swipe right and just send spam email to absolutely everybody and hope. It's quite easy for Lints and I to actually see when somebody's actually put a little bit of effort into it. It shows professionalism. It shows that you really actually want to work with us. You know, and it's not like we're not out there trying to find deals. That's a large part of our job. So find people that can introduce us, look at LinkedIn, see how we're connecting, you know, work it, put a little bit of effort into it. But I think where a lot of people make mistakes, and you referred to it at the beginning, a lot of like companies that are raising Series A and looking to raise 5 million spend a lot of time working to get an introduction to me. I'm a seed investor. It says that clearly. It kind of says it on the, you know the investor, know what they do and what they don't invest in. It's very clear on Golden Gate. It's very clear, you know, on Cocoon. I find a lot of founders just waste their time on that side of it by talking to the wrong funds.
I would like to add a few things there. So I definitely agree on it. I think where what it comes down to in the end is just making it relevant. Yes, the best way is definitely to, you know, are you able to get a warm introduction to, you know, one of our portfolio companies or one of Cocoon's portfolio companies? The difficulty there might be that those founders have, you know, their work in their company to work on, and they'll make 1 or 2 introductions, but at 10 they're like, yeah, you know, I have a job to do, which is kind of running this company. But it is not hard to make it relevant, and it's as Blakey said, is you have to put in the work. It is for me, and we've done numerous sessions on fundraising and getting introductions. It is literally just putting in the work, and I always get a little bit sad when I see that people don't take the effort to do a proper introduction. And you have to see it as your deck is important, your metrics are important, you know, but getting in front of the VC, actually getting in front of them is as important, which basically means that before that happens, you have to put in the work. It's similar to, you know, we're not going to blindly invest into a company. We want to do some work in terms of due diligence, you know, reference checks, talk to clients. When you want to get connected to a VC, see whether it's relevant. Yeah, if you're raising a Series B round, you're unlikely going to talk to Cocoon. You want to look at funds that have done historical Series B rounds, or if you're raising an A round or raising a seed round, look at the investors that play in that landscape. It's not really hard to find that information. And once you found it, how can you make it relevant? And you know, I think there is a lot of data readily available that you can use to make it relevant, as opposed to just copy pasting the same email to 15 investors.
I totally agree with you. These days, information is such a commodity. So any founders that don't even do that basic work just scares me, you know.
Yeah.
So, you know, I'm quite mindful. We've got 20 minutes. Okay, you go for it.
One point I'll add. One point. Also, just remember, it's not just about the first meeting. I'm amazed how many people spend all their time on their deck and then don't actually have like their due diligence, like, or their data room set up. So again, you lose momentum. If I asked I asked a founder, was it a couple of days ago, I said, oh, can you share with me, you know, this is really interesting. Can you send me with the financial forecast? And they said, oh, we don't have it yet. So I was like, well, all these numbers, you know, they spent all their time building this beautiful deck, but there was nothing behind it, and you lose momentum, and it doesn't make you look good either. So just get everything ready that you could potentially, you know, the data room is critical for the next step. If it's not ready when a VC says we want to see it, it does not put you in a good light.
Right. Okay, so like I was saying, we're shifting into the main event now. I know what would you invest if 10 million is the title of the webinar. But before we start spending money, Lints, can you share with us, talk about your worst investment? Like, we all like to hear those war stories.
Can be anything, right?
Of course.
Yeah. So
no names.
No, I wouldn't mention any names. God no. No, so what one is that I always, when I was like starting as an investor, I always kind of believed in that, you know, sort of 10 to 1 ratio. You kind of take 10 companies, one of them will definitely kind of go through the roof and will make a return for everything that you invest in. I actually learned that it doesn't work like that, because those 10 investments still need to make sense. So one of the worst investments I made was into an industry where I literally had zero knowledge of, like zero. And this sounds good. Let's give it a go. And in the end, you know, what I literally learned from that experience was, even if you don't know the industry, get a second, a third, fourth, and a fifth opinion. Compare those opinions, then do your own research and some benchmarking, and then make an educated decision. You can still get it wrong, and it's fine if you then still get it wrong, but at least you have learned enough just to make an educated decision. And that's what I've kind of taken along with me during my entire investment journey. But that was a painful mistake.
Right. Blakey.
Okay, I want to caveat this. I did this a long time ago, and I will never do it again. So it's really bad. Okay. So it's similar to Michael. I invested in a space that I didn't like, and I spent about 9 to 10 months getting to know the founding team. Fell in love with the opportunity, and even though there were red flags everywhere around it, I just fell in love with what this company could do if it worked. So, you know, there was an issue with the founding team, but my view was I can sort that out afterwards, after we've invested. But probably the biggest mistake that I made was I actually knew by pure chance, I actually knew one of the world experts in this space. He was married to one of my closest friends. And I went to him and I showed it. He looked up at me. It won't work, Michael. They're trying to break the laws of science. And I was like, yeah, okay. What did I do? I totally ignored it, because I was like, he doesn't know the business. He doesn't know what he's talking about. World-leading expert, doesn't know what he's talking about. Yeah, he still gives me grief every time I see him, because obviously he was very right and I was extremely wrong. But I think that the big thing is, and it's one of the things that you do have, like investment committees in funds, if you spend a lot of time getting to know opportunities, you know, we're VCs, and at that point I was an angel. We want to make money, but we want to also make a difference, make a change. And it's very easy when you spend so much time with an opportunity and you put a lot of time and effort into it, even before you invest, to what I would say, go native and ignore a lot of red flags that can come up. Having an investment committee that hasn't being sold on it, they look at very much on a fact base. It's an important aspect of the VC model, and one that I've actually implemented across the board in anything. Even as an angel investor, I had to pitch it to somebody to get their approval before I could actually make the investment.
Right. I think investment committees, they're all there for a reason, and I'm glad I'm the one who gets to do the asking about the worst investments. But we've heard all of that, like not fall in love with an opportunity, to listening to what they Yeah, so now fantasy football time. Again, I get to ask the interesting question. So this is a question where you ask 10 people, you get 20 different answers. And, I'm mindful of the fact that $10 million means different things to Cocoon. It means different things to a growth fund like Golden Gate. But, it's really just metaphorical, right? So instead of asking, what would you invest with $10 million now and why? Like we discussed before, let's flip the question around. Would you invest $10 million last year differently and why? Lints.
Oh my God. Yeah. So the worst answer is saying yes and no. So I'm gonna try to avoid that. Yes, so I would, because I am continuously educating myself and luckily still learning. I think where I might have underestimated the potential size of the education space in general. So I'm talking beyond maybe your cookie cutter tutoring apps. I'm really talking about the innovation that can happen within the education industry across the board in Southeast Asia. I think there is an impressive opportunity there. And if you would ask me about education last year, I would have said, yeah, interesting, but I'm getting a better grasp and a better view on how big this opportunity actually is. So if I would have that 10 million last year versus that 10 million now, I would put a bigger portion of the 10 million towards investing in education startups, because I'm now effectively, because COVID basically showed me that, oh yeah, there is a lot of broken parts in this ecosystem where not only tech, but the kind of smart people can put a lot of innovation to work. So the answer would be yes. And then, where would you put it? I would then focus a bit more on education.
Right. And Blakey?
I would say yes as well. I think, and a slightly different reason maybe than Lints. I actually believe that COVID-19 has actually been in terms from a tech point of view, digitization has actually been really good for a number of sectors that, that I probably wasn't looking at hard. So in terms of like travel, hospitality, tourism, telemed, a lot of it, it was happening at the, at the peripheral. And obviously these, a lot of, not telemed, but a lot of the other industries I mentioned have been devastated by F&B, by COVID-19. But coming out of COVID-19, I've got to look, when I'm investing, I've got to look at like a year ahead. I'm trying to guess where the world is going to go to be so. I can't, when you're at growth, you can kind of be on the tip of the wave, where things are going up and you can see traction. I've got to guess where that is going to happen. I've got to be like 12 months ahead of what is kind of hot sectors. I believe a lot of these industries that have been devastated are going to be pushed much more faster than beforehand to digitize, to look at ways of becoming more efficient, supporting like the new world, the new kind of new world order when we come out of this. Because I don't think things are going to pick up as quickly as everybody wants. I think, tourism, hospitality, and events, that it's going to be longer for them to actually come out of the doldrums. So they've got to look at other ways of actually still generating money at a reduced cost and keeping their margins, still being able to make money. So even though it sounds a bit, weird saying those markets, I think that's same in terms of like telemed and edtech. I think also that it's probably accelerated adoption in those markets. So for me, I will look at them, but again, it's a very, very crowded market. There's a lot of companies that have been kind of, people have been kind of investing in edtech, and a lot of them for the last like 5 or 10 years, and they've been really hard. They found it really hard to actually break through. I think COVID-19 has actually been the thing that has kicked the door open to the adoption. So anybody who's coming to me now, which is like a year away from kind of going to market, they're probably actually missing a bit of the wave. They're going to be slightly late to the market. So I probably won't, you know, it's not, again, I'll come back. There's always people, and everything I say, I'll take with a pinch of salt, because if an good ed tech company comes to me tomorrow, I'm going to invest in it. But in terms of on that side, I will look at markets that have a problem, and I believe they're going to have a problem for more than 12 months. It's going to be a new problem that they haven't really had to identify. And I'm going to look at companies that have identified where the world is going to be in 12 and 24 months time, maybe not today, but in 12 and 24 months, and actually solve those problems.
So the good thing is that we've got Zoom and recording these days. I'm gonna watch this video next year and give you a call to see if Lints or Blakey is right. But let's now move on to the Q&A session. So we've got a lot of very, very excited audience, and I'm just, you know, there's a lot of questions. I'm really trying to pick the most relevant ones. So let's talk a bit about business model. There's a question. Can you talk about what you would consider a COVID-proof business model? I think this is maybe quite an easy one to answer now that we have, 3-4 months into COVID. Maybe Lints, you want to take this?
Well, in all fairness, unless you're in the vaccine business and fortunate enough to find a vaccine that actually works, I mean, all of the businesses have been affected. And I wanna highlight one thing. And this is an interesting debate that I've had with peers in the US, in Europe, and especially here in Asia. So the natural assumption, for instance, and I'll just name this one example just to show that there was no COVID resistant business. So the initial thought was that e-commerce would solve everyone's problem, and that, you know, the biggest boost would be e-commerce companies. If you look at the data, for instance, in the US, although e-commerce has definitely grown, it hasn't made up for the foot traffic and the physical commerce and the physical retail in the country. But here comes another problem. If you're an e-commerce business, you are reliant and dependent on supply chain. Supply chain has been severely hurt by COVID. So effectively, e-commerce will be hurt as well. And whether it's the difficulty of, you know, getting certain SKUs, the difficulty of getting enough staff for your logistics, the difficulty of borders being closed, it has taken a big toll on a larger supply chain. We tend to look at industries as being isolated, and I like to kind of talk about where people say, for instance, travel has been clearly directly hurt from day one. But then effectively, if you look at travel businesses, and whether it's OTAs or airlines or hotels, I mean, they use software as well. So companies on the B2B SaaS side that are providing to these travel businesses, they get hurt as well. So whether it's payment gateways or other services. So I never look at it as, you know, isolated, you know, one industry get hurt. So I think there's been industries that people wouldn't naturally see it as, oh, this is going to be affected by COVID, that have been affected. I think what has been more important, that founders that have been able to respond fast and said, I'll take the necessary measures to get through this period. It's more than just making cuts, but I'll take the necessary measures to get through this period. I think that is a more important measure than the industry that you're in.
Right. Thanks, Lints. So Blakey, you've been talking about people. So let's get you a people question. What are some of the key traits a founder should have to build a scalable business?
Look, you can talk, I think, a lot about, like, you've got to have hustle, you've got to have vision, you've got to, you know, I think if I look across the board at my successful founders, one is they've got to have, Lints mentioned it earlier. I think you have to have the ability to hire people better than yourselves.
It takes great
And also,
humility to say that, actually, and
you know,
wisdom.
I always, well, the thing is, it's you've got to have, to be honest, it's actually confidence. You've got to have the confidence to believe that, you know. But the one thing that, you know, if I talk to any entrepreneur, they always have say the same thing. It's, there's a talent shortage, Michael. We can't find the right talent. And to be quite honest, it's amazing how good founders always find talent. That there's more than enough talent in Singapore, anywhere. You know, if you go to Silicon Valley, you have the same. There's more than enough talent. The fundamental problem is you can't afford it. You know, as a startup, you can't afford to, you know, good talent normally has a good job. Great founders have the ability to sell a vision to those people and persuade them to give up their high-paying jobs at Google, at Facebook, or wherever they are, and come and work for their startup. And I think that's the most critical thing that I've actually seen across the board that good founders need to have. And I think the other one is, if you're looking within the team, a good founding team, so run just individual, but looking at it, a good founding team is one that kind of have opposite skill sets, but have respect for each other and different and coming at it, you know, at the beginning, when I'm investing, very rarely can they employ, you know, all the people they need to employ. So it very much comes down to the founding team. So it's the people that can kind of multitask, can actually, you know, find the ways and being very adaptable. You know, there's a very thin line between confidence and arrogance. So for me, it's those that are confident and believe 100% in what they're doing, but then can adapt very, very quickly when they see somebody else has come up with a better idea, or, you know, they've made a mistake and they need to adapt quickly. So I think for me, that's the thing. And as a leader of a team, you know, of a founding team, I think one of the important things is clear communication, especially as we're going through COVID-19. You know, both with, you know, their employees, the ones that are staying, and even the ones that are going, just be very clear, keep people up to date, keep people motivated, but also with investors. You know, make sure your investors, because if you need funding and you need it quickly, it's normally the investors that can actually, are your current investors, which are the ones that are going to support you. So you've got to keep them in the loop and be very clear. Even if you need to change your plans, always be very communicative. And if anything, I would say over-communicate rather than under-communicate.
And Lints, anything to add? You must have seen your fair share of entrepreneurs.
Yes, we've seen quite a bit. I think the one thing that I'm always very aware of when speaking to entrepreneurs is how do I feel about their ability to execute on that promise? And it sounds like an open door. Yeah, of course you need to execute and you know, be diligent, etc. But you have to imagine that as a founder, there's going to be tons of distractions. You know, even speaking at a conference, it could be a distraction. So I'm always very aware of looking about how founders kind of deal with noise around them, and are they able to keep their eye on the ball. Specifically when there's like tons of opportunities coming in and out, investors like bugging you. If you're a fast-growing company, there's inbound investors that want to put money into your business. Are you able to then say, okay, you know, this is adding value to my business, or no, this is adding a distraction. So I'm that sort of personal trait is something that I find extremely important, because I know down the line, when your business is growing and scaling, you will have a ton of those distractions day in, day out. And I want founders then to make the right choice.
Right. Well, the hour just flew by so quickly. You know, it always does when you're talking to good friends. We've now reached the end of the webinar. Lints, Blakey, it's been a pleasure. I've learned much, and it kind of also helps me to consolidate my thoughts as we go through this COVID period. You know, I hope you audience have learned as well. And we did not manage to cover all the Q&A, but if there are further questions, I believe you can reach out to Lints, Blakey, or even myself. through Wild Digital or LinkedIn. And I don't know if this works like below. Thank you, everyone. And
Thank
have
you
a
very much, Martin, for being a
safe,
great moderator as well.
no problem. Have a
Thank you, Martin.
safe and healthy week ahead.